Welcome back, and joining me for a closer look at what's playing itself out on the market scene is Towell from Sasfin. Well, thank you so much for your time, Rob. I come
Pleasure.
back after 2 days off, and the JSE is way off its 84,000 high that I saw, I think, right before I left. And the Rand at some point in this morning was close to 18 Rand against the US dollar, but it has strengthened slightly since then. What's the deal here?
Well, I think we had quite a big close on Friday where we saw a rebalancing in all of the indexes in South Africa, and we saw a big sell down in South African equities on Friday. And then, a weak US market as well. And that's led to like a very weak day yesterday. And again, it followed through today. So another negative day for the JSE. And there's a few reasons for it. I think that, as we get closer and closer to the interest rate cut, people are starting to reposition their portfolios. They've invested, earlier, waiting for the interest rate cuts, and now they're starting to take a little bit of profit out of the system. And we'll see what happens once the interest rate cuts comes through. So there's a lot of moving around in portfolios, going out of tech, more into industrials, etc. And it's causing a lot of rifts and a lot of big swings in the market at the moment.
Quite a lot that has happened in our market today. A lot of company news out. Before we actually get to results, let's talk about Spar, because it finally announced that the sale of its Poland division is finally final. They gave us all the details, but you had the markets, the investors punishing that stock by as much as 14% at some point. What were investors looking for there, and really what were they bothered by in that update?
I think Spar had said that they were going to sell that asset, and I think that the market is expecting a much better sale on that asset, and the share price had moved along with the new elections and a little bit of flow into South Africa. It moved the share up quite substantially. But the deal that's come through really is a very weak deal for them. It's the only benefit really is that on a cash generative level, they're not going to have to use so much cash to keep that system going, which was a big drag on their free cash flow. But, they're selling it for 85 million, plus they're keeping all the debt. So if they keep all the debt, it brings their debt up to about 2.6 billion in Spar, and they're going to have to find a way to pay that. Now, will they sell that down by selling Switzerland? Possibly. If they sell Switzerland, then they could get rid of the debt, but it leaves them in a situation where they're still quite heavily indebted. And the market was just expecting a better outcome on the sale of that asset, and maybe expecting them to get rid of that debt straight away. So they were punished for that today. The market did, initially were down 14%. I think we finished about 6.8% down. So once they read through it a little bit, I think a bit more of the positive side, knowing that, a bad asset is now, coming to an end. I think it, pulled back slightly, but the market was definitely expecting a better outcome on the sale of that asset.
Very expensive exit there. Quite an interesting turn of events and expectations. Let's go into another retailer that came out with the results today, full year results. On a comparable basis, they had their turnover growth at 4% for continuing operations. But really, that's where the growth ended, to the point where headline earnings per share dropped by 16.8%. What's your take on what Woolworths got in the bag in the annual period?
Yeah, they're a weak set of numbers, and it shows you how difficult the trading environment is in South Africa. Their numbers also were 53 weeks, not 52 weeks. So if you strip that out, sales grew by about 9%, but inflation was 7.9%. So sales really only growing marginally, or not enough, to keep the business going. And then they're also getting competition on the food side. So food still did well again for them, but not quite as much as it has before. Hasn't been able to pull them through like it did before. Then apparel, again, locally under pressure, as well as in Australia under pressure. So they're getting a double whammy from not being able to recover in Australia. The Australian consumers is very much under pressure. And if you take a look at Foschini's numbers in Australia, they're far better than Country Roads numbers in Australia that Woolworths produced. So, on the food side, on the apparel side in Australia, under a lot of pressure, and again in South Africa. So just a weak set of numbers in general from Woolworths, and they're still battling to fix that apparel business.
Yeah, quite interesting also that you say that TFG in Australia did better than a Country Road, but still their sales are a little bit low. Of course, they released their 21-week trading update. What did you make of that? I did see also that the stock was also punished at some point by over 3%.
So all three of the divisions, the UK, Australia, and South Africa were down. So across the board there, they also saw difficulty in their numbers. they've run that business really well over the last few years, and it's a much leaner business, and they've got really good brands, and their purchases into their businesses have been really good. But the general consumer is under pressure with these high interest rates. We saw in their numbers as well that the amount of cash sales is moving up and is a very strong part of their business. So even though they do offer credit, they're not pushing credit out too much. And I think you'll start to see that improve and an increase in credit once interest rates start to come down. So you need the interest rate to come down so people will actually physically take that credit. So as I say, part of it is because they're tightening their credit, but part of it is people just can't afford the credit at these rates. So you need that to reduce and interest rates to come down to allow the credit cycle to open and give more sales. But in general, a relatively good number from Foschini. I mean, they're up about 40% from a year ago, so they've really rallied hard. And I think now just a little bit of the air coming out of the sales, extra savings that people did have after COVID is totally out of the system. And the increase in interest rates has got the better of the consumer. So I think a fair set of numbers for them, but I think you could definitely take profit out. But a very good business, one that we like, and we would add it at, if it comes down a little bit lower.
All right. Well, let's get to your stock pick for today, Rob. What are you picking?
So quite controversial at this stage, but we're looking at Kumba Iron Ore. The share was trading at 600 Rand. It's now, today was down at about 320. The iron ore price is under pressure, and the steel in China is under pressure, and relative negativity around China. However, they're a very good cost producer. They produce a very high quality of iron ore, which doesn't get affected as much by the price, and their demand doesn't get affected as much. And we think at these lower levels now, nearly 50% lower than they were, you could start to build a position here. It's going to be a bit difficult over the next month or two as we clear the interest rate cycle. But I think that at this level, 320 and below, your risk to the upside is better than your downside risk. And therefore, I think that's my stock pick for the moment. And I think these are good levels to enter.
All right. Well, thank you so much for your time and for your analysis on what has been moving investors' money in today's trading session, Rob. That was Robert Towell from Sasfin Wealth.